a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about SPAC ETFs. SPAC is such a hot area. In fact, 2020 can be called the year of SPACs. 2020 was a year of so many things, but definitely SPAC and IPOs had a great year in 2020, and SPACs continue to be hot in 2021 as well. So last year was the busiest year for SPACs and IPOs on record. And this was mainly because investors had a lot of appetite for these companies of the future, fast-growing companies or companies with a lot of growth potential in areas like sports betting, space tourism, EVs. And then there was abundant liquidity in the system because of these massive stimulus packages, monetary and fiscal stimulus. So that is why a lot of liquidity and investors' appetite for these companies of the future was fueling this boom. And according to SPAC research, 248 SPACs IPO'd last year, raising $83.4 billion. And this year so far, the year has just started, 75 SPACs have IPO'd and have raised $21.5 billion. And several high-profile investors, billionaire investors like Bill Ackman, Chamath Palihapitiya, NBA star Shaquille O'Neal, they have launched their SPACs. And according to the Wall Street Journal, about 300 SPACs are currently seeking deals, and they have about $90 billion in cash, and an average of 5 new SPACs are launching each business day this year. So let's take a look at what exactly is a SPAC and what should investors know before deciding to invest in them. So companies typically use 3 routes to go public: a traditional IPO route, or a direct listing where they do not raise any new public money, or through a SPAC or a special purpose acquisition company. Now, these SPACs are also known as blank check companies. They raise money from investors only with the purpose of finding a private company, a startup, and then taking it public. And SPACs have no other operations. They hold cash, about $200 to $400 billion typically, and then they have about 2 years to find a startup, a small private company, merge with it, and then bring it public. So this process has been very popular of late because this is less cumbersome, less time consuming. So it is easier for small startups which do not have a lot of historical performance records, but they have very good growth expectations. They can take this route to go public. And I think SPACs were made famous last year because of Chamath's deal with Virgin Galactic, which was such a successful IPO. That is why SPACs gained more popularity last year, particularly with investors. Now, the problem is that by taking this route, companies can avoid the traditional due diligence process that IPOs normally have, IPOs normally have. And SPACs can make those rosy growth projections about their projected future results, which traditional IPOs are not allowed to make to investors. And historically, SPACs do not have a good record of delivering returns to investors. Now that may change, I do not know, because more growthier companies are taking the SPAC route of late in 2020 and 2021. But investors should remember that because of lack of due diligence, sometimes companies with some shady accounting practices, Nicola comes to my mind, they can take the SPAC route to go public. So there would be some very successful SPAC IPOs like Virgin Galactic, and there would be some which do not have very good accounting practices. Among the successful, DraftKings also comes to my mind. Now, so because there would be some which would probably perform very well, and there would be some which would fail, not deliver suitable returns to investors. So this is a risky area. So that is why taking the ETF route makes more sense, because ETFs provide diversified exposure to this new and risky area. And in fact, there are 3 ETFs already, because ETFs, there are always ETFs in hot themes. So let's take a look at those 3 ETFs. In fact, one of them is brand new. It just started trading like a few hours back today. So the first one I'm highlighting is by Defiance Next Gen SPAC IPO ETF, ticker symbol SPAC, SPAK. It is the first SPAC ETF, and it holds 80% of the portfolio is in companies that have taken the SPAC route to go public, and 20% to SPACs themselves. This has about 59 million in assets, very new, and charges 45 basis points, cheapest SPAC ETF. Now, to learn more about this ETF, you can go to the quote page on Zacks.com. I did a video with the sponsor. You can listen to the video too. And I did a podcast with the sponsor. So you can listen to that podcast. And you can take the external link to look at the Defiance webpage for this ETF. And you will see that DraftKings, Clarivate, which is an analytics company, Virgin Galactic, the famous space company by Richard Branson's, these are the top holdings in the portfolio. There are other SPACs which we are not too familiar with. Now, the second one I'm highlighting is actively managed. It is the SPAC and the new issue ETF, ticker symbol SPCX. It holds SPACs and companies that have gone public within the past 2 years using the SPAC route. Being actively managed, it has an expense ratio of 95 basis points. And this has already gathered 75 million, though it made its debut just about a month back, little more than a month back. Again, to learn more about this ETF, you can go to the quote page on Zacks.com. And from there, you can go to the external home page and read more about this ETF, what it does. And you can look at the holdings too. Churchill Capital, Starboard Value Acquisition, Neuberger Principal. These are among the top holdings in the ETF. Social Capital, that is Chamath's, which took Virgin Galactic public. Now, the third one just launched today. And this is also actively managed by hedge fund Morgan Creek and financial technology firm Exoc. The ticker symbol is SPXZ. It targets largest 50 pre and post combination SPACs, has an expense ratio of 1% due to active management. Now, this is not yet on our website, but you can go to Morgan Creek website to learn more about this ETF. It will appear on our website soon because it is very new, so we just take some time. So it seeks to invest 2/3 in about 50 or so largest companies that have gone public via SPAC, and 1/3 in a combination of SPACs. Now, looking at the holdings, you will see Luminar, Denimer, Dermtech, Desktop Metal, Virgin Galactic is also there. These are among the top holdings in the ETF. Now, I do have performance on this slide, though these are all very new. And as I mentioned, the actively managed one, SPCX, that has a performance history of just a little more than 1 month. So I have used that time period since inception of that one. And I have compared versus QQQ, the Invesco QQQ ETF, because that is also a growth ETF. And these ETFs also target companies of the future, growthy companies. So you will see that the actively managed ETF SPCX has done pretty well, and that is the top performing. It is up about more than 20% in one month, little more than 1 month. I also have the performance of the traditional IPO ETF by Renaissance, that is called IPO. Now, the Defiance product and IPO have almost similar performance, and the QQQ ETF is up a little more than 6% over the past month or so. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer, and also make sure to subscribe to our videos so that you do not miss anything. And I'll see you next week.